Hi, everyone. Thank you for joining us today. I'm Marcia Butler, the webinar director at Advice Chaser. And as you're coming in the webinar room, we want to welcome you. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions and make comments in the chat box, and the presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well, and if we can't get to your question, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Dwight Davenport is the managing principal at Greenport Capital Advisors, leveraging over 30 years of experience in wealth management. Dwight offers expert insight and guidance to his clients. Before co-founding Greenport Capital Advisors, Dwight was a principal at Vodia Capital and a principal at Penobscot Investment Management in Boston. In addition to his experience in wealth management, Dwight has a strong track record of successful entrepreneurial ventures in the finance industry. Dwight earned his BA from Norwich University Military College of Vermont, and we've done a lot of preparation. I'm really excited to have Dwight here. I think this is going to be well worth your time, and we're going to dig into some nitty-gritty stuff today, folks, so you are in for a treat. Dwight, I'm going to turn the time over to you, and I know we're going to have more of this conversational, so I'm really excited to do this webinar with you today.
Well, great. Thank you, Marcia. I appreciate the introduction. Again, I'm Dwight Davenport, and I am a co-founding principal of Greenport Capital Advisors. Greenport is a registered investment advisor, and as such, we are held to a fiduciary standard of care for our clients. What that means is that we have to act in our clients' best interest. Legally, we have to do that. We would do it anyway. We're going to go through a number of things today. I just want to make the point that if we talk about performance of investments in the past, it's not an indication of how they will perform in the future. And I think what we really want to cover today is to give you some education, some information on recessions, the causes of recessions, the effects that they have, and the interplay between recessions, your portfolio, and your financial goals. So as Marcia mentioned, we're going to dig into some nitty-gritty stuff, and I want to start with this. Actually, this is a graph that depicts consumer sentiment. The question that this graph asks is, how are you feeling? How do you feel right now about the prospects for the American or the U.S. economy? And if you look at this graph, you can look out beyond 2020, so you can kind of go back to you could look at 2022, 2023. What's really notable to me in this is that the sentiment regarding the American economy right now is almost worse, or maybe even a little worse, than it was in 2008. So if you're not feeling great about prospects for the U.S. economy right now, you are not alone. I find this graph particularly compelling, and it also indicates to me partly as to why we have an inverted yield curve at the moment And so stay tuned on that. I'm going to explain an inversion of the yield curve later on in this presentation, but it's a really important data element and something to keep track of.
It's interesting that, um, you know, seeing that 2008 versus now, those 2 points, it's very interesting because even like COVID, it's lower than COVID. So it's interesting how that's been um, showing where the consumer confidence is.
Well, I think this is just my opinion, but I think that nowadays the financial media and the places where people get their information plays a much more significant role. Probably plays as large a role now as it ever has in the way people perceive how things are going or where they are headed to. So I think it's very important. The other takeaway from this graph is that if people are feeling really this badly about the economy right now, it's really important to figure out how to sort through all the noise and figure out
Mhm.
what really matters. And that's something that we focus on. We are sifting through financial noise constantly, every day, all day on behalf of our clients. And what we try to focus on are things that we know are observable facts that we can act upon. So
All
it's
right.
really
You're
important.
quelling some of the fears here already, hopefully. So let's go ahead and get into this.
Yeah. So as we go through this process, there's some questions that I'd encourage you to keep in your mind or at least contemplate. The first one is, how well positioned is your portfolio to weather an extended economic downturn? Does your financial advisor uh, initiate contact with you at least 4 times a year to discuss your goals, your portfolio, and the things that you're trying to accomplish? Does your portfolio have a governing document that outlines the scope of work that will dictate the rules for the investment management process of your portfolio? It's called an investment policy statement. It's really important to have one of those because it's a set of rules that governs how your portfolio is approached. It governs the positions that you're in, why you're in them, when you're in them, and when you need to get out of them. It's very helpful to have one of those in place and almost, I would say, necessary. The other question is, do you know what's in your portfolio? Can you explain every position that's in it and why it's in it and how that position reflects what you're trying to accomplish in general with the portfolio? Which leads to kind of the next question, which is, does your portfolio and the positions in it truly reflect the things that you're trying to accomplish? Does it reflect your risk tolerance? Does it reflect your time frames? And does it reflect, the overall circumstances that are special to your situation? So those things are very important to keep in mind as you kind of think about the conditions we're in and going forward, and keep those in mind with respect to your financial goals.
And I know we're going to revisit this checklist at the end, folks. So hopefully this will make more sense as we keep going. All right, let's talk about kind of current events. I know that I just wanted to, for those of you who are on the recording, we're talking in March of 2023. So can we talk about, are we in a recession now? Is it going to get worse? Is it going to get better? I'm sure that's what is on people's minds.
Yeah, excuse me. So the answer is, at this particular time, we are not in a recession. So that's the short answer. The addition to that answer is that and we're going to cover this later in the presentation, but there are some indications that are very important to keep aware of. And those indications suggest that we are more likely to be into a recession at the end of 2023 or sometime in the beginning of 2024. That's what the data points to at this particular moment. We'll be seeing that a little later on in the presentation. But there is a joke in our business, in our industry, that the market has predicted 9 out of the last 6 recessions. So, there's a lot that speaks to people putting out their opinions, saying we're going to have this, we're going to have that. At the end of the day, we really have to look at observable facts and keep a clear head.
Okay.
So instead of, very often when recessions are looming on the horizon or there's discussion about what's going to happen, the market starts to go down. And I hear it all the time. Oh, I should have sold. I should have gotten out. The fact of the matter is you really can't time a recession. And it's just not prudent. It's not practical. It's not pragmatic. And instead of trying to predict when a recession is going to happen, it's just better overall to be prepared for one. And to do that, um, we have to really understand a few things. We have to understand what factors have contributed to recessions. We have to understand how stocks behave and how investments behave generally during economic downturns. And really, what matters most is what you can do now to prepare for it.
All right, we're going to talk about the causes of recessions. We've got a lot of graphs to talk through. So I know we're prepared to answer questions here. I want to mention, go ahead and put questions in the chat if you don't understand any of the terms or any of the graphs that we're presenting here. Okay, so let's get into this first one.
Okay. So I like the definition of a recession. There's basically two definitions, or one that complements the other, I should say, but kind of a narrow definition is that they're generally defined as two or more successive declines in gross domestic product. The definition that I prefer is a little broader in scope, and it expands that definition to a significant decline in economic activity spread across the economy, lasting more than a few months. That's generally reflected in gross domestic product, real income, employment, industrial production, wholesale and retail prices. And so that to me is a broader and more complete explanation and definition of what a recession actually is. So if we look at this graph, we have four time periods: early, mid, late, and then an actual recession. Underneath those four, we have data elements that we actually can observe, and we're actually living through this right now. So the early part of the process, do you think of this as kind of a cycle? The early part of the process is accelerated economic activity, work hours rise, wages rise. And coupled with that, the central bank, meaning the Fed, and they're going to be meeting later on today to discuss interest rates, but the central bank eases interest rates, which means lowering interest rates. That makes money less expensive and more available. The economy gets flooded with money. When we get into the mid-cycle, that's when profit margins are starting to kind of reach their peak. Employment is kind of reaching its peak as well. People are demanding more credit, meaning they're borrowing more money. And the result of that is you have money pervading into the economy, money flowing into the economy. And you start getting inflation as a result of that. So these are things that we're just living through right now. Right now, we're in the late stage of the cycle. Labor markets are really tight. I think we all know that. I think we all understand that costs are soaring. Earnings per share of companies and U.S. companies is actually starting to contract. It's because their profit margins are contracting. And the Fed is raising interest rates. Another way of saying that is that central bank money policy is tightening. They're making money more expensive. They want to reduce the flow of money into the economy. Then the fourth one here is when we're actually in a recession. And we all know what happens then. Economic activity declines, corporate earnings go down, unemployment rises, and people borrow less money. So that's the cycles. Yeah.
Yeah, so I know we were talking beforehand about why people might already feel like they're in a recession, especially with inflation, and maybe even though technically we're not in a recession, it might feel like a personal recession.
That's a great point. I think that's absolutely what is happening right now. Just a real world example. I mean, it's just buying a dozen eggs. Your money's not going as far as it was, and that feels like you are in real terms. you have less money in real terms, which is the same effect that you would feel if you're suffering from a recession. So those feelings are comparable, but they don't necessarily indicate the same thing.
Okay. All right. Well, let's go ahead and move on to this. This is probably my favorite graph out of all of them because it shows more of the history and maybe some perspective here. So can you talk us through this one?
Yeah, this is a great one. I love this graph. If you go back to 1950, there's been 11 recessions since then. That's not a lot. That's really not a lot if you think about it, going all the way back to 1950. The average lifespan of a recession is about 10 months. The takeaway from this graph really is that the purple that's below, that's the recession. Okay, the blue that's above is the expansion. So where recessions are somewhat short and not as impactful, and that's not to suggest they're not painful. We're well aware of how painful recessions are. But from a technical and financial perspective, the expansions are much more significant. A great example here is 1960. If you can see from 1960 to 1970, that's a huge expansion. We had a number of things going on during it. We had the war on poverty, Lyndon Johnson's war on poverty. We had the Vietnam War during that time. There was a lot of stimulus going into the economy. And look at the expansion that happened then. So expansions are sort of broad and longer lasting. Recessions are not as long lasting and shorter. And the takeaway, I think, from this graph is that if you go to 2008, we had a lot of toxins. 2006, 7, I'll go back to 2005 even. 2005, 6, and 7, there was a lot of toxicity building up in the American economy in the form of bad loans. We all remember what happened in 2008, but it all came to a head. The Great Recession of 2008 really served to sort of detoxify our economy and get those poisons and bad debt instruments, bad investments, bad money out of the economy. The net result of that was 10 years of just incredible growth right all the way up till 2020 in March when COVID hit. So that's one of the key takeaways is recession's kind of a natural part of the economic cycle, and they serve to kind of, I'll say, detoxify the economy to some extent.
All right. Let's talk about how the stock market responds to recessions and maybe responds and maybe predicts. I know we talked about that a little bit in our preparation.
Yeah. Well, okay. So stock markets and recession. So a bear market, we've all heard the term a bear market. And a bear market is a market decline of 20% or more. Bear markets and recessions often intersect, they come together. The point that I think is interesting here is that the market is in and of itself kind of its own entity. It gathers data, it assimilates data, and it acts on data. And in that way, it's almost like a living organism. It has intelligence, reflected by the fact that it assimilates and acts on data. And so the markets are what we call forward-looking. The market tries to anticipate what's going to happen in the future. That's what they mean by forward-looking. So what we're seeing here is, if you look at where this market peak is, this is.
Are you talking about the dark blue line here?
Yeah, I was going to go
okay.
back to the lines. Yeah. So the dark blue line is the market. The light blue line is the cycle peak, so the industrial production, right? And so what happens is the market will, if you notice from that purple dot, that's where the market peak is. The market at that point is starting to sense that maybe earnings are not going to be as good. There might be some economic contraction, meaning, just the economy gets smaller. And as a result, it starts to sell off. in advance of when that actually happens, because the light blue line underneath is actually going up while the dark blue line is actually trending downwards. So the market tries to anticipate a downturn in the economy, and typically that is about 6 or 7 months prior to when that actual downturn actually happens. The inverse of that is true as well. And if you go beyond just the cycle peak, you can see that dark blue line where it intersects the light blue line. That's when the market starts to price in a recovery. And you can see that in the beginning, industrial production is going down, but the market's going up. And that's why, in some cases, when you have a recession or a late stage recession, you can actually have a market that is going up while the recession's still, in place and still happening. Industrial production is still going down, but the stock market's going up. It's because they're anticipating what's going to happen in the future.
And that's interesting because I guess that can be good news knowing that the market is showing positive signs of a recovery.
Yeah, the market will anticipate a recovery much in the same way as it will anticipate a downturn. So the market will start to recover before the downturn, and it'll start to sell off. The market will start to pick up before the upturn, and will also sell off before the downturn.
Yeah. And that's what you were saying about it being forward looking, correct?
Correct.
Okay. All right. So we've talked a lot about these graphs. Let's talk about economic indicators, things to watch. There are some terminology here that you'll have to explain. So just want to let people know, viewer, we're going to explain it. Please put in the chat if you need any further explanation.
Okay. Here are the 5 warning signs of a recession. I'm going to dig into the inverted yield curve in just a moment, but the other 4 are relatively self-explanatory. So unemployment will increase. Consumer confidence, we just talked about that. The thing about consumer confidence is it can become a little bit of a self-fulfilling feedback loop. When people start to believe that things aren't going well, they can actually make that happen by believing it.
I can see that.
So that's the psychology of what we do. I would say that 80% of our business is actually just kind of the psychology of it, and that's why it's so important to cut through the noise, the headlines, the fear, the opinions, this and that. It's really important to cut through all of that and really get down to what really matters. So moving on, housing starts. In my opinion, I think housing starts are a very important indicator, because I think of sort of the typical American household as a microcosm of our economy. Pretty much everything in the US economy is represented in your house, from energy to entertainment to services to information technology. Pretty much all of the sectors of our economy are represented in your house. And when housing starts slow, it means that all of those other things are slowing down. That's an indicator that actually lags. It's not something that's out in front. That's something that we kind of realize afterwards.
Okay.
The other one is the leading economic index, which is just a broad index. And if we see a broad index of the economy, and if we see that kind of declining at least 1% from the prior year, then that's something we need to pay attention to.
All right. And then can you explain just like these numbers here, average months, what these numbers indicate?
Right. So when you get unemployment, so when the yield curve inverts, and again, we'll talk about that in a sec, you get about 14 and a half months before there's a recession that happens. When unemployment sort of gets to its 50-year low, you get about 5.6 months. This is just the number of months that you can sort of, in general, expect a recession to start. Before, so when the event happens, it's that number of months that the recession actually kind of kicks in.
Okay, I was confused about that one. What you meant is employment is rising. Does that mean it's 5.6? I think you said it for 50-year low. That's what we are now.
No, it just says It just says that when employment starts to reach its real low point, you can
Mm,
count on maybe somewhere around 5.5 months before recession kind of kicks in.
interesting. Okay.
You
All
know,
right.
you
Well,
blend all of these together and it gives you some data elements. These numbers are just sort of,
averages.
yeah, you can't, as I mentioned earlier, you really can't predict when a recession is going to happen. Just you can kind of think of these data elements as sort of guideposts on the journey to a recession, I suppose.
Okay. All right. So let's talk about maybe the hardest thing to understand, the inverted yield curve.
Yeah. So this one could get really complicated if we want it to get complicated, but I think the best way to think about it, and this is actually what it is, when short-term rates are higher than long-term rates, that's when the yield curve inverts. That's what an inverted yield curve actually is. So typically, when an investor wants to tie up their money for longer periods of time, they're going to get paid more for tying their money up for a longer period of time. Those are longer term, 10 years or more. When those long-term rates are lower than the short-term rates, it suggests that people are not confident with the economy. Right now, the 2-year Treasury, I believe, is around four. It's over 4%.
Mm-hmm.
Just have to check my notes here. Yeah, the 2-year Treasury right now is 4.21%, and the 10-year Treasury is 3.43%. So you get paid more right now for putting your money in a 2-year Treasury bond than you do a 10-year Treasury bond.
Wow.
When that
Interesting.
happens, if you look at this graph right here, when that happens, so the purple spot on the graph,
Mm-hmm.
that purple dot, that's when the yield curve inverts.
Okay.
So let's call that what, 1966, the yield
Mm-hmm.
curve inverted, stayed inverted for a while. That gray bar that you see there is the recession that followed it. So in let's call it 73, it inverted, and then we had a recession. 1980, it inverted. I remember that recession. That was a significant one. And so on. So you can see that when the yield curve inverts, we typically get a recession. That's why it's such a strong indicator.
All right. Let's move on to the next indicator.
Okay. All right. So the New York Fed calculates probabilities for a recession.
Okay. So this is a probability graph.
This is a
And so
probability.
this is a 0% probability to 100% probability, correct?
Correct.
Okay.
Yeah. Um, so when the New York Fed calculates the probability of a recession, and that probability exceeds 30%, we basically get a recession. I mean, it's pretty amazing how that works. Go back to 1962, all the way back. We didn't have one right there in 66 and 67, but this behavior pattern is really consistent going back to 1962 in general. You can see in 72, the probability of a recession was 70%, and we had a pretty significant recession after that. Same was true in I'll call it 1980, 1981, 82. If we recall the gas line, coming out of the 70s with the gas lines, really high inflation, the probability of recessions at that time was 100%. And then 2008, another significant recession after, we got up above 30.
All right. And I know we have a more current graph. Here's this interesting how this is
Yeah.
Right before 2020.
So this is really interesting. So the last time the last time the probability went above 30%, we had COVID, but COVID was not necessarily related to that. It was just kind of a standalone event. What's really interesting though is if you go to the end of 2022,
Mm-hmm.
the Fed, we talked earlier about whether we're in one or whether we're not in one. I mean, at the end of 2022, the Fed's probability calculation on whether we're going to have a recession rate at this time was between 5 and 10%. it wasn't even, it's barely even noticeable.
Yeah, but I know I asked you to pull a more current graph, and so let's talk about this one.
Right. So you compare the end of 2022 to what the Fed is calculating as a probability for January of 2024. That's a significant indication right there. So what this graph is telling you is that the New York Fed is calculating that the probability of a recession in January of 2024 will be about 57.13%.
All right.
That's an attention getter for sure.
Yeah. Yeah. All right. So let's get into preparation, because that's kind of the meat and potatoes of this presentation. What can we do to prepare?
Yeah. So as I mentioned before, bear markets, market declines of 20% or more, and recessions generally intersect. Timing the market is, to time the market consistently and to do it accurately and well over a long period of time is next to impossible. It's really impossible. Let's be honest, it's impossible. It's just a fact. On the other hand, and so a lot of people say, yeah, I should have gotten out, I should have gotten in, I should have done this or that. At the end of the day, you really just have to prepare your portfolio for what the world is going to bring to it.
Okay.
And not all sectors of the economy do poorly in a recession. This is the S&P 500. The sectors that are blue, the blue bars are sectors that actually do well in recessions, or at least to help you to defend against recessions. And those are fairly, I would say, self-explanatory sectors. Things like consumer staples, it's like food, clothes, utilities. You have to turn the lights on in your house. You need to get health care. These are what we call defensive sectors, and they stand up particularly well during recessionary periods or economic downturns. Things that don't do well are, consumer discretionary. Do you need to go out and I don't know, buy that stereo or just, those are discretionary sort of spending things. Those don't do well in recessions for obvious reasons. People don't have a lot of extra money to spend. Financials don't do well because interest rates compress, meaning they can't make as much money because they can't lend as much money. As we discussed earlier, lending contracts or reduces during recessionary periods. So financials are not a great place to be, and nor are industrials, because companies, and we saw that during recessions, industrial output is lower during recessionary periods. So the point here is, you should look at your portfolio and look at it in the context of this is what I meant earlier. How is your portfolio positioned to weather against a recession? Where are you? In other words, how does your portfolio look with respect to what sectors of the economy you're participating in? What are you doing there? Why are you there? And should you be there? I mean, these are the kinds of things that I think would be a worthwhile conversation with your advisors. The other part of sort of appropriate portfolio management is to make sure that you're properly diversified. And in this case, we're talking about bonds. And by bonds, in this case, I'm talking about US government bonds. The purple bar is the stock market going down at different events. I'm going to pick some events that we're all kind of familiar with. Let's just take COVID, for example. This is the most recent one. It's kind of easiest. The S&P 500 lost almost 34% in March of 2020. Government bonds were basically flat. The government bond index was down 9 basis points at 0.9%, not even 1%. So the point here is, and depending on which government bonds you bought, actually some government bonds were actually up during that time, during the COVID pandemic time. So the point here is that if you're properly allocated and you're properly balanced, diversification is key to preparing your portfolio for downturns. Obviously, not being down 33% is is very beneficial to to have a position in your portfolio that's not down, just offsets the pain by a lot. And that really matters over the long haul.
All right, let's revisit this recession checklist, and maybe you can talk about maybe some action items that people can do in order to make sure they're meeting this checklist.
Yeah. So in sort of thinking about what you can do, I think the first place you start is the first place you start is with yourself. Are you sleeping at night? Are you worried about your portfolio? Are you worried about your assets? We all are at some level, but I guess the question is, how worried are you? And then you try to identify the things that are really, if there's anything that's bothering you, try to identify what those are and get a clear understanding of what your questions should be. And so it's a matter of pulling your statements out, looking at different positions in the portfolio, understanding what they are and what purpose they serve and how they are either contributing or not contributing to what you're trying to accomplish. And that's just kind of a general mindset and framework from which you should approach kind of looking at this, with the understanding that, probably by the end of this year or the beginning of next year, the probabilities are pretty significant that we'll have, even sharper downturn in the economy.
All right, well, let's go ahead and get into some questions here. I've gathered some, and I want to mention that if you have questions, go ahead and put those in the chat. Here's the first question. You talked about toxicity in the market that's cleared out by a recession. What kind of toxicity is it that is going to be cleared out by this current incoming recession?
Yeah. Well, right now it's inflation, right? It's a great question. There's a number of kind of toxic things. What's happening right now, I'm sure we're all familiar with what's going on in the news right now with Silicon Valley Bank. There's some concern about banks and their portfolios. I think it's yet to be determined the extent of the toxicity that exists there. Clearly, Silicon Valley Bank had some toxicity. I can tell you that they had a large percentage of their portfolio in very large loans that were loaned out to companies that were not in a position to necessarily just pay them right back, while people were going to the bank asking for their money out. That's one significant contributing factor to the failure of that bank. The other contributing factor is the fact that the Fed is raising interest rates at such a high rate of speed that we have that inverted yield curve. So it's incenting people to kind of take their money out and relocate it in a place where they can get a better rate of return. That's contributing. So I would say that probably the most this is a tough one. And the Fed is going to meet later today. And what the Fed decides today is going to tell us a lot about how they feel about banks and the condition of banks right now, because the Fed is going to weigh out this decision of, do we fight the toxicity in the environment right now, which I would say is pretty much inflation? How hard do we fight that? And they have to weigh that against whether or not that's going to hurt the banks even more and cause more economic pain for people. And if you want, I can circle back with whoever, wants to talk to me a little bit more about some of the stuff later, but maybe if there's other questions we can.
Yeah, that's okay.
Hopefully that helps. Yeah.
All right. So you talked about an investment policy statement. How do you know if you have one? And I have a follow-up question to that, but can you first answer that?
Yeah. You have one when your when your investment advisor comes to you and says, look, here's our, it's a document. I can tell you what I do. I have our clients sign, and we sit down. I just sit down with clients. We talk about what they're trying to accomplish, what's in the portfolio, any restrictions in the portfolio, what they want to see in there, what they don't want to see, how that relates to their goals. This is all outlined in that document. And that document governs the management of that portfolio. It sets mandates that govern our behavior, and it governs also and informs our clients' behavior. It's their money. They can do whatever they want, but it informs their behavior. So the answer is, you have an IPS when your investment advisor comes to you and says, here's the IPS and I want you to sign it.
Okay.
You'll know when you have one, and really you should have one because everybody's held to a standard, and it's something you can go back to and look at and say, okay, how are we doing? Are we drifting? Is there mission drift here? Is there style drift? Are we staying on course? It's critical.
Okay, very interesting. And so that was actually that follow-up question. How do you know when it's time to revise your statement?
Yeah, that's why I asked earlier. Is your advisor initiating contact with you for at least 4 times a year? Okay, I just think that you have to be talking to people at least 4 times a year. You can, it doesn't have to be a long dissertation. You can just say, how are you doing? Has anything changed? Here's where our thinking is, and here's why we are doing what we're doing. And here's how that affects you and your portfolio and the goals that we discussed. So the answer is it's really up to some people want to hear from us more frequently. Some people want to hear from us less frequently. Um, but we'll always we initiate contact a lot more than that. But I think as a general rule, you should be hearing from your advisor that's initiated by them at a minimum once a quarter.
All right. What role does having emergency cash funds play in preparing for a recession?
It plays a huge role.
You
A
talk a little,
huge role. Yeah.
yeah.
So that's a general answer to a kind of a specific question, but it plays a very, very significant role. One of the most damaging things to portfolio performance is volatility. And so you want to have enough cash, you know, at hand, enough what we would call liquidity at hand to manage these ups and downs that a recession is going to bring to your portfolio. You really don't want to be selling out when the market's down. You just don't. You don't necessarily want to be. You just want to try to manage through it and mitigate the volatility as best as you possibly can. But trying to time market events and trading events is it's just not a good way to run, a money for a portfolio that's for a family, that's for people who have real goals, that have real aspirations, are really trying to do something real with their money, not just playing around. So the answer is, you probably want to have at least 6 months. Every situation is different. I give sort of general rules of thumb. These rules of thumb are very general. They may or may not apply to you, but to start somewhere, you could say, listen, if I had 6 months of cash reserves in advance of anything, then I know I don't have to kind of get into my portfolio or do something in a bad time. So the answer is look at your situation, figure out what your cash needs are, try to think about, how you can put some money aside and do that. The good news is that, a 2-year treasury bond is paying over 4% right now. So 2-year treasury or even a 1-year treasury is considered cash because it's considered a risk-free asset because it's backed up by the full faith and credit and taxing power of the US government. So you can actually get some return on cash or cash equivalents right now.
All right. And then one final question before we have to close. If you're having a lot of emotions about where the market is right now and you're tempted to pull out of the market, what can you do to kind of quell those fears and maybe do the logical thing? Talk to me about that.
Oh, that's a good one. 90% of this business is psychology and behavioral elements. I would say that 80% of my job is managing behavior. So the answer is, and this is what we try to do. This is why it's really important to be in contact with your financial advisor, even in this case, if you're really nervous, a lot. You really need to understand what they're doing, why they're doing it. That's why I asked that question earlier. What's in your portfolio? Why is it there? And what's it doing for you? So the answer is you gotta just try to sort through the noise and all of this information that comes bombarding at us through all these financial media outlets, and just sort through it. Think about your long-term goals. Think about how you can't time the market. Sit down with your advisor and go through this portfolio and make sure that the things that are in it really represent who you are and what you're trying to accomplish. It's tough. It's really tough. It's tempting to want to pull and do these things. If you do that, it's not the most effective way to manage the portfolio in these moments. Hopefully that helps. But
Yeah, well, thank you so much for answering those questions. We do have to close our question and answer portion. But again, if you have any further comments, feel free to leave those in the chat and I'll make sure to save that chat so we can reach out to you afterwards. Well, Dwight, I want to thank you so much for having been here and for offering your expertise. We want to thank the organizations that have made this webinar possible today. I just got a question. Will we have access to the slides? We will be sending out a replay of this event to your email, and you're welcome to share that with friends and family. Give us about a day to send that out. In addition, we will be putting this on our website at advicechaser.com under our webinars. So you're welcome to rewatch it, take a screenshot of those graphs. It's a lot to digest. I told you it was we got into the nitty gritty here. You might want to listen to it again. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for you, your life, and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much, everyone, for coming. And hopefully we'll see you at another webinar soon. Goodbye, everyone.
thank you.